dark day in 2008, Warren Buffett watched the entire stock market collapse and quietly moved $1 billion in. AI just taught me exactly why that wasn't crazy. It was the whole strategy. Okay, I have to be honest with you. 6 months ago, I knew almost nothing about value investing. I'd heard the name Warren Buffett, knew he was rich, knew something about buying stocks and holding them for. That's it. So I did something that felt a little ridiculous at the time. I used AI to teach me how Buffett actually thinks about money and investing. And what I found over the next few weeks genuinely changed the way I see businesses, money, and financial decisions. Stay with me because a few of these lessons might change how you think too. Let me set the scene. I started by feeding AI every major piece of writing connected to Buffett that I could find references to. His annual shareholder letters, interviews, quotes, and the core principles that people who study him obsessively talk about. I asked it to explain concepts to me like I was starting from zero. I asked it follow-up questions. I pushed back when things confused me. I basically used it as a patient, endlessly available tutor who never got tired of my questions. And over the course of several weeks, I started to see a framework that honestly felt less like a financial system and more like a completely different way of thinking about the world. The first thing that hit me hard was this idea about circles of competence. Buffett talks about only investing in businesses that you genuinely understand, not businesses that sound exciting, not businesses that someone on the internet is hyping up. Businesses where you actually understand how they make money, what makes customers come back, and what risks could destroy them. The AI explained this to me using a simple thought experiment. Imagine you had to run every company you were considering investing in. Could you actually do it? Could you explain the business model to a 10-year-old in under 2 minutes? If you're stumbling and guessing, you might be outside your circle of competence. This one concept alone made me realize how many times I had bought or considered buying something simply because it felt like a good idea without actually understanding it at all. The second thing that genuinely fascinated me was the concept of moats. Economic moats. Buffett uses this term constantly, and it refers to the sustainable competitive advantage that protects a business from its competitors, the way a castle's moat protects it from invaders. I asked the AI to break down the different types of moats, and the answer was eye-opening. You have brand moats, where companies like Coca-Cola have such deep consumer loyalty built over decades that competitors genuinely struggle to take market share even with better or cheaper products. You have switching cost moats, where once a customer starts using a product or service, the pain of switching to something else is too high. Think about how annoying it would be to migrate all your data from one software platform to another. You have network effect moats, where a product becomes more valuable as more people use it. And you have cost advantage moats, where a company can simply produce things cheaper than anyone else at scale. Learning to identify these changed the way I look at businesses completely. Now I genuinely cannot walk into a store or use an app without thinking about what protects this company from competition. But here is where I want to slow down, because the AI taught me something that most people completely miss when they talk about Buffett. Everyone talks about buy low, hold forever. That gets repeated constantly. But the deeper truth I kept uncovering was that Buffett is actually obsessed with the quality of the business itself, not just the price. His mentor, Benjamin Graham, was all about buying cheap stocks based on pure math. Buffett evolved past that. He said it himself in various ways over the years, that it is far better to buy a wonderful company at a fair price than a fair company at a wonderful price. This distinction sounds small, but it is everything. And the AI helped me understand why. A mediocre business at a low price can still destroy your wealth if the business keeps deteriorating. A great business at a reasonable price tends to take care of itself over time because the underlying economics keep compounding in your favor. Speaking of compounding, this is where things got genuinely mind-bending for me. The idea is that returns building on themselves over long periods of time create results that feel almost impossible to believe. Buffett has described compound interest as the eighth wonder of the world in various quotes attributed to him. And after going through the numbers with the AI, I completely understand the obsession. Rule 2. Never forget Rule 1. The AI helped me understand this is not just a pithy saying. It reflects a deep mathematical reality. A 50% loss requires a 100% gain just to break even. Avoiding disaster is not defensive thinking. It is actually the most powerful offensive move you can make. Now I want to talk about something that surprised me even more than the financial concepts. Because when I started asking the AI about Buffett's psychology and decision-making, I uncovered what I think is actually the most underrated part of his entire approach. The man is remarkable at ignoring noise. In a world designed to make you feel like you need to be constantly reacting, constantly checking prices, constantly adjusting, Buffett essentially treats short-term market movements as almost completely irrelevant. The AI explained this through something Buffett has described as Mr. Market, a concept he inherited from Graham. The idea is that the stock market behaves like an emotional business partner who shows up every single day, offering to buy your shares or sell you his shares at whatever price his mood dictates that day. Sometimes Mr. Market is euphoric and offers absurdly high prices. Sometimes he's terrified and offers prices that make no sense given the actual value of the business. The wisdom is in recognizing that you never have to respond to him. You only act when the price he offers makes rational sense for you. I spent a whole afternoon going back and forth with the AI on this concept because it felt like it had implications far beyond investing. In our current world of constant information overload, social media, and financial news designed to create urgency, the ability to simply choose not to react might actually be the rarest and most valuable skill a person can develop. Buffett treats it as a competitive advantage, and the more I thought about it, the more I agreed. The AI also helped me understand Buffett's approach to management quality in a way that surprised me. He looks for managers who are honest, passionate about their business, and who treat shareholder capital as genuinely precious. What stuck with me here was how much Buffett relies on trust and alignment of incentives. He wants managers whose personal interests are directly tied to the long-term success of the company, not just short-term metrics that look good in quarterly reports. At this point in my learning journey, I started getting into some of the harder questions. I asked the AI what kinds of mistakes even smart people make when trying to apply Buffett-style investing, and the answers were humbling. The first big mistake is pattern matching without understanding. People see Buffett buy a bank stock or an airline or an energy company, and they try to copy the trade without understanding the specific reasoning behind it. Buffett has an enormous amount of context, relationships, and analytical depth behind every single decision. Copying the action without the reasoning is almost guaranteed to go wrong eventually. The second mistake is patience theater. This is where people say they are long-term investors but then panic and sell the moment a stock drops 20%. Real patience is not just waiting for things to go up. It means holding through discomfort and fear with genuine conviction based on your analysis of the underlying business. The third mistake hit me personally: overconfidence about your circle of competence. I had to be honest with myself that there were industries I thought I understood that I actually only understood on the surface level. Tech is a big one. Many people feel comfortable with tech because they use the products. But using a product and understanding the competitive dynamics, the margins, the capital requirements, and the long-term risks of an industry are completely different things. The AI pushed me to be more honest about where my understanding actually ended. Then I got into something that I think is genuinely fascinating about Buffett's approach to cash. Most investing advice tells you to always be invested, that cash is trash because of inflation. Buffett thinks differently. He loves having a significant reserve of cash sitting ready because it gives him what he calls optionality, the ability to act decisively when genuine opportunities appear. Some of the best investments in history came during market crashes and panics, when prices dropped to levels that made no rational sense. If you are fully invested with no cash reserves during those moments, you cannot take advantage of them. Cash is not laziness in this framework. It is loaded ammunition waiting for the right moment. What I want to leave you with is this: the AI did not replace reading, thinking, and doing my own work. What it did was dramatically accelerate my understanding by being available at every moment to answer questions, challenge my thinking, and connect concepts I would have taken months to piece together on my own. If you have any interest in understanding how money actually works at a deeper level, I genuinely think there has never been a better time to start learning. The tools available right now are remarkable. The question is whether you are willing to put in the thinking required to use them well. That part the AI cannot do for you. If this hit differently than you expected, drop a comment below telling me which concept surprised you the most, because I am genuinely curious. And if you want to go deeper on any of these topics, I have got more coming. See you in the next one.